In light of the horrific events in France over the weekend, we have seen short-term global markets drop, but in terms of major currencies, the response appears moderate. Joining me to discuss this and more is Alvin Baker from Informa Global Markets. Alvin, when looking at the euro area, inflation came in today at 0.1%, and core inflation rate accelerated to the highest of 1.1% in more than 2 years. Following this weekend's events in Paris, is more stimulus on the cards, and to what extent?
The horrific events in France obviously gripped markets in Asia Pacific, and without a lead from the European or US markets, obviously a very defensive stance was taken. Having said that, the European markets have displayed quite a lot of resilience, as have the currencies. And at the moment, losses on bourses are up to about 0.5%, and S&P futures have really clawed back much of their losses also, and that's just moderately lower as I'm speaking to you now. Yield-wise, in bond markets, they've fallen back by between 2 and 4 basis points. Today's inflation data, there was a small risk bias lower after Draghi's comments last week at the EU Parliament address. But to all intents and purposes, within the Wires analyst forecast range, does it change the ECB's stimulus in December? No. We think that his address last week was pretty significant. So we're still going for stimulus in December from the ECB. In terms of what they're going to do, I think it's going to be an overall package. Today we heard from Constancio talking for the first time about the broader range of instruments that the ECB has got, and the way he phrased risk being utilised could mean that corporate bonds, equities, and other asset classes could be used instead of just pure upping QE. There seems to be still a few on the council that are opposed to increasing the amounts from 60 billion. The market has still got more priced in. It's thinking that should be increased to between 70 and 75 billion, with extension beyond September 16 by 9 to 12 months. So overall, the market is still very much expecting the ECB to follow up its words with action in December, and if somehow it doesn't transpire, there'll be a huge disappointment, something which the ECB haven't been of late used to doing. They usually have been promising and delivering at least as much as the markets expected, and I think on this particular occasion they might actually want to do a bit more.
Germany's ZEW will draw markets' attention tomorrow. The indicator recorded 1.9% in October and is expected to escalate to 8.4% in November, according to Societe Generale. Is this realistic following promising GDP figures last week?
Okay, the German ZEW indicator is notoriously volatile. Has a propensity to swing violently in both directions. So I wouldn't be surprised to see an 8.4 number. To put that 8.4 into context with some recent numbers from the ZEW, ZEW has seen an average of about 35 as a year-to-date average, and the 1.9, even though it was the lowest since October the 14th, in the previous month it was over 12. So 8.4 isn't a massive read. GDP, as you said, it's promising in terms of the quarter-on-quarter and year-on-year. Not spectacularly, because the quarterly average since the start of 2014 up until Q3 this year is around 0.35% quarter on quarter. So we're just trending really, but it is looking better than it was 2 years ago. So yes, we could get a number 8.4 or even higher.
Canada's manufacturing sector slumped, output plunged to its lowest ever reading. Bank of Canada has cut interest rates twice this year to try and stimulate the economy. Looking ahead to CPI release this week, can Canada's economy rebound alone, or is an improving US economy the biggest catalyst for Canada?
Well, the Canadian recovery is still very much tied to the US recovery story. The BOC scenario is for a shift from the consumer to export growth, which should spur business investment going ahead. The US, being Canada's largest trading partner, accounts for something like 75% of Canadian exports. So if the US economy was to falter, then we expect Canadian exports will be directly hurt, and therefore the Canadian economy will also take a hit. The BOC also expects the US recovery to continue, which should also spur Canadian growth. The main counter to this sort of fairly rosy picture is that the commodities complex continues to plummet, with key materials like copper at 6.5-year lows. Oil markets, unfortunately, they've looked like they're going to rebound. They fall back again on mainly supply dynamics and weak demand from China, etc. So there's still headwinds for the Canadian economy. So it won't be just a case of the US guiding Canadian growth. It will be the overall global picture. And as we saw in recent weeks, the OECD and IMF have been cutting back growth forecasts across the board. So we're not expecting too much overall for Canada to perform well on its own, per se.
Well, Alvin, thank you for taking the time to speak with me today. That's all from me. But for all the latest Ducoscopy updates, do keep clicking back. Goodbye for now.